Okay, hello. We haven't done the review session for my cost accounting class yet on what we actually need to know for the final, but I wanted to go ahead and do a couple of videos on all of the things that I had in my notes and going through and doing all of the lecture slides. So this video will just be on things that I had in my notes, but keep in mind that this video does not include going through the variance formulas, including the fixed overhead. That's a sheet that I'll probably do like maybe a separate video on with some examples to go through, but just this will be more of a quick video since I have less in my notes because the majority of this unit was on example questions with the variances. So I'll go ahead and get started. Standard costing general principles. And this is for the all that variance stuff, chapter 10 and 11 in McGraw-Hill. So when we put things in inventory, we put things as standard. So that means when we buy raw materials, um, we put we debit the asset of the raw material at the standard price and standard quantity. Um, and also when we credit the cash or when you do that expense, like the expense account, I think, but definitely for the asset end of things. Whenever you pay for the inventory or reduce means like use that inventory, you put that in at the actual amount. So when we pay for the raw materials, we credit or like debit that accounts payable by like what we actually paid for them. And then you would have a favorable or unfavorable difference there. And likewise, if we when we use the raw materials, we'll credit the actual amount of materials that we used. And the difference between the standard and the actual is recorded as variance. That would be like raw materials price variance or direct labor uh quantity variance, things like that. Like variance expense. It's basically just an expense account. So it's something that we have to zero out every year because it's not like it's just one of those like kind of fake accounts for things. I need to excuse me. I would like it to only show me the term first. Okay. Unfavorable variances. Um, they're always debits for journal entries. So anytime you have unfavorable variance, like for for price of raw materials, unfavorable variance for that is a debit. Um, and that's because you increase the cost of goods sold. Uh, did I say that wrong? I think I meant to write decrease here. That's my bad. Okay. But yeah, unfavorable variances, they're always debits because since these are like expense accounts that we have to close at the end of the year, you close them out to cost of goods sold. And so that increases cost of goods sold, which will decrease net income. So that's kind of why they're unfavorable because they end up actually increasing the cost of goods sold and decreasing net income. So they're debits. Similar idea with favorable variances. They're always credits because when you close them out at the end of the year in the adjusting entries, you end up debiting cost of goods sold. No, yeah, you end up crediting cost of goods sold, which decrease cost of goods sold and will increase net income. So that's why they're favorable. And so that expense account, when you are recording the variances, those are credits. And I kind of just went through this actually, but the end of period adjustment journal entries for unfavorable variances, you debit costs of goods sold and credit unfavorable variance, since when we originally recorded it, it was a debit. And likewise for favorable variances, you debit the favorable variance and credit cost of goods sold, since when we first recorded the variance, it was a credit. Variable overhead variances, almost identical to direct materials and direct labor variances, except it makes more sense to say rate rather than price, but we'll just keep using AP and SP in the formulas and stuff. You can kind of see that more on the sheet than and like in the formula sheet, like just both of those than anywhere. So now we're kind of moving on to chapter 13, management accountants. They kind of sit between the decision maker and the data scientists and the developers. So the data scientists like collect the data, um, and like run it and everything. And the decision maker is like the person that actually makes the decision, like the CEO. But management accounts are the ones that take that data and have it tell a story and make it make sense to someone that's less technical, like the CEO. And also, um, it's always good as a management accountant to try new things, get the data for that, and see if it's working or not. Whether it's a new product or just seeing if maybe not maybe having ice cream Fridays will boost worker morale enough that's worth the cost or not. Supporting how to support data decision making. You use prescriptive analytics, and prescriptive analytics is trying to figure out what we should do. So that's like those like scenario analyses, because there's a lot of things we don't really know, like or things that kind of stop us that we need to analyze how to best what's the best thing for us to do. So we have to keep in mind we have resourcing constraints. So things like we're constrained by time, money, uh, capital assets, um, storage, all those things. Like we're limited. Conditions are changing. Like, and for example, like the political landscape is always changing. Competitors are always doing new things, which kind of leads into disruptions, like disruptive innovation. Differential analysis. This is a prescriptive analytic technique. It determines the change in profit typically associated with differences in revenues and costs for alternative courses of action. So it's asking what is the value add if you do something, or is there no value add? Relevant costs and revenues. These are things that occur in the future and are things that change due to actions. So, things like, uh, mm, I don't know, taxes you pay for your Schedule C. You pay those later in the future, and the amount of taxes that you pay change due to the actual amount of work that you do for your Schedule C business. Like, do you actually like keep doing your to the side business or not? Non-relevant or irrelevant costs and revenues are things that occurred in the past and or are unchangeable by actions or also are just sunk costs. Sunk costs are always irrelevant. So, another example of an irrelevant cost or revenue is the money you made, um, like 3 years ago for your W-2. Like that's not relevant anymore. That's something from the past, something unchangeable. Um, like if you're a salaried employee and you don't get bonus or overtime, that's unchangeable unless you get fired, but that doesn't really count. Like or you die, right? But those are like extraneous things. Like it has to be something that like you can basically like normally choose those like actions like that. And I mentioned sunk costs. So what's the sunk cost fallacy? It's you already spent limited resources and you psychologically feel like you need to keep spending resources on that route, or else the resources already spent won't be worth it. So it's like you start college and it's expensive and you get halfway through and you're having a really hard time, or maybe you just don't like what you're studying, but you feel like since you've already spent so much on college, you have to finish your degree or else it'll be a waste. So you keep spending the money and your time and like your utility emotionally to finish out that degree. That's the sunk cost fallacy. Sensitivity analysis, that's a type of differential. Ugh, pass. Oh my gosh. Okay, I didn't really mean to stop my share. I just wanted to pause it, but this works. So sensitivity analysis is a type of differential analysis, right? So recall differential analysis. It's the change in profit, excuse me, change in profit associated with differences in revenues and costs because of alternative courses of action. And we just went through how um, these profits and costs are relevant because they are changeable and in the future. So the sensitivity analysis, that's where management accountants want to know the assumptions or conditions where the object may not be profitable. So that's digging a little deeper into the differential analysis. All right. Getting into that, we have the price elasticity of demand. That's the measure of change in consumption of a good if price goes up or down. And you use that when you're doing price optimization. So, for example, if um, a product for a firm had a price elasticity demand of 2%, that means that if price increases by 1%, then demand goes down by 2%. So the price elasticity of demand is for every 1% price increases or decreases. So likewise, if price goes down by 1%, then demand increases by 2%. So again, price elasticity of demand, measure of change in consumption of a good if price changes. Um, the data solver in Excel from the mini lab to maximize profit, your goal, like, and not just goal, like, as a vague thing, but literally what you put in the data solver as the goal is profit, and what you're changing is the quantity. And you want each used less than available. Quantity to produce, you want that to equal integer. Uh, just because when you're maximizing profit, you're wanting to look at whole units and you need to change that thing in the data solver to simplex LP for this, for maximizing profit. Similarly, minimizing cost, basically the same thing, except you hit the min button because it normally just automatically does max. Um, all right, so moving on. Persistent cash flows. So now we're into like chapter 14. This is the start of chapter 14. So persistent cash flows, these are things where you get the same amount of money like continuously, meaning each period. So something like subscriptions or rent, like the firm is getting paid the same amount of money each period. Bonds too are a great example of this. Some not persistent cash flows, that'd be things like selling equipment or capital resources, or lawsuits. Like you can only sell your I don't know, your giant building in downtown New York once, right? Uh Most of the time with lawsuits, you're only paying out the whatever once or receiving the whatever from the lawsuit. Like that's not a all the time event. What can companies do to make cash inflows more persistent, meaning keep people buying them more than once? So things like textbooks, for example, where if you're buying the textbook, maybe if you're a teacher, right? If you're a teacher, you buy the textbook, you only need that one textbook. It's not like you're buying the textbook every year just for the fun of it for yourself. And similarly with iPhones, right? Or laptops or iPads, like you only really need one until it craps out. So what will keep the revenue for companies even more persistent than just consumers buying basically one and done? You can do subscriptions or renting, or make more new editions, updated versions, etc. So maybe for the book example, the textbook example, in the perspective of a student, students are just gonna rent the textbook for a semester instead of buying it because they think, oh, I'm not gonna need this textbook ever again in my life. So they don't want to buy it, they just rent it. Plus, it saves the firm money because, especially if the textbook is online, then they don't actually have to like give away the textbook permanently. Um, Similar thing. So with the textbook example, you can make more new editions, updated versions, etc. So that's more along the teacher example. If you're a teacher, you buy your textbook 10 years ago, you think I'm not going to need a new textbook again because uh like I'm not buying like this textbook every year just for fun. I already have everything I need. But if they make new editions or updated versions with a lot more information in it or a lot more relevant information, then as a teacher, you're going to need the to buy new textbooks of those newer editions. That's the same thing with iPhones. Um, like I have the iPhone 12 right now, but I see all these cool things going on with the iPhone. I don't know what they're on now, 15 or 16. And I think, man, I kind of want some of that. So that's how they get people to go and buy stuff again. Or subscriptions and rent. A lot of video games now and or even streaming services, but streaming services great example, but video games now, they'll I guess or like playing online games like the PlayStation or the Switch, you pay a subscription to play games online rather than paying just to buy the PlayStation, then you're not never paying Sony anything else ever again. Prescriptive analytics, that's again, what should we do? Benefits here should be measured in financial terms. There's four ways you can do that: revenue enhancement, revenue protection, cost savings, cost avoidance. I kind of get a little bit more into those in the other video I'll do. Capital budgeting. There's four methods for that that I really like. He said we have to know for the exam when he was lecturing. NPV, IRR, the payback methods, and AARR. And so, what are those? Well, NPV, that's the net present value. It uses RR, which is the required whatever rate, to discount all cash flows to their present value. And it's basically just answering the question, are you making money in today's dollars? And it gives you that answer in dollars. Its only con really is that it assumes cash flows are reinvested at the RRR, which most of the time is pretty realistic, but still worthy to note. Steps to do that, especially for Excel, figure out non-discounted net cash flows. You want to know if overall are we profitable, non-discounted. So that means just in like dollar values without seeing what those dollars are worth from the future today. And then step two, we actually do the NPV. So that Excel formula is equals NPV, parens, RRR, and then the values of the cash inflows. So it expects the values to be formatted. Um, okay, so these are from my notes from his lecture. He kind of lectured it wrong. I have it right in my other video, but basically it's values of cash inflows minus cash outflows. Um, because it's doing the like basically when we did it by hand in the homework, you could see that the cash outflows for those capital initial capital investments, they happen in year zero. So NPV, like nothing happens there. So you just subtract them like outside of the NPV equation. IRR, what is that? That's the rate of return. The present value of expected cash flows from a project will equal zero. What does that mean? That's kind of a crazy sentence. Basically, it's just the rate you need to break even. This incorporates the time value of money in it, and it gives you the answer in percentage. So, let's see. Where NPV, it does incorporate the time value of money, obviously, but it gives you the answer in dollars. It's it does have more cons than the NPV. Like it's difficult to see, mm, like why you have the differences that you have with longer lived projects. Like let's say you were looking at one project that was 5 years long, um, of income, and another one of like 25 years. Like the IRR just tells you the percentage it will take to break even. It's not telling you, it's not really showing you or demonstrating very well that one is a lot longer than the other. Also, it assumes cash flows are all reinvested at RRR, which is definitely possible, but like also is not a given. The steps for that for Excel, first you figure out the non-discounted net cash flows, just like the first step of NPV. And then you do the formula for Excel, which is equals IRR and all of the values. So this is where we include the expenses, which should be at in the first row anyway, at year zero. And but you need all of this to be formatted as the column, like all in a column with expenses at the start. If you don't have any expenses uh selected in there at all, you're just gonna get a hashtag, it's like a number hashtag number error, which means the answer went to infinity. So that happened to me in class. So definitely want to note that. Payback method. That's where you calculate the length of time required to earn back the amount of the initial outlay for capital expenditure. Here it's cost divided by uniform profits equals the payback period in years. And for the so mm, for the final year, you do the money you owe divided by the income of the final year plus payback period until final year. And that's the total payback period. So basically what I'm saying there is like you do the capital expenditure minus the income coming in, and you see where you finally break even, like what year was that? But if it's between years, so that's kind of where that final year thing is. Like like if there's not a year where it equals exactly zero, you're gonna break even between years. So you do up to that point, like let's say you know you break even at some point between years 3 and 4. You have 3, and then for that final quote unquote year, you do the where did I say that? The last bit of money you owe divided by the income of year 4. And so that tells you how much of that in between year 3 and 4, what did it take for you to break even? And then you add that 3 back in. So you get your total payback period. Cons here, it doesn't account for the time value of money. So You would want to do the NTV on the stuff afterwards. And that's basically what the discounted payback method is, which is our other method for the payback methods that actually accounts for time value of money. Finally, AARR, the average percentage rate of return expected on a capital expenditure divided by the initial investment or average investment over useful life. Cons, it doesn't account for the time value of money, and it's taking numbers straight from the financial statements, including the tax rate. So you kind of almost have to wait until the end of the year to do this one. At least that's my assumption there. And that's this video. Yay.